Hey everyone, welcome back to the Caderna podcast. I'm your host, Brian Caderna. In today's episode, I'll be sitting down with Tom Siomades to talk about an economic forecast for 2023. Needless to say, this is an episode you're not going to want to miss. If you don't know who Tom is, let me give you a quick background. Tom Siomades is the Chief Investment Officer of AE Wealth Management. He is a Chartered Financial Analyst, or CFA, with over 30 years of industry experience. Previously, Tom was the managing director of Hartford Funds, in which he oversaw more than $100 billion of assets under management. Tom is a graduate of the United States Military Academy at West Point and later earned a master's degree from Webster University. We're going to talk about how being an officer in the Army and leading men into battle helped translate to a successful career in investing. Our conversation is going to cover not just what's in store for 2023, but we'll really take a deep dive into today's global economy, including inflation, investment philosophies, how the Fed can engineer a soft landing, and China versus the US, the state of our two global superpowers. Now, if you follow me, you'll realize a lot of these topics are at the core of my upcoming book, again, which is titled, What Should I Do With My Money? Economic Insights to Build Wealth Amid Chaos. You can now pre-order that wherever books are sold or pick up a copy at our book launch in February of 2023. So without further ado, let's welcome Tom Siomades.
Is going to require work and time and sweat and toil.
If money wasn't an issue, what would I be doing?
Don't worry about it. You'll figure it out.
Change is the only constant.
The Caderna Podcast.
Tom, welcome to the show.
Thanks for having me on, Brian. It's a pleasure.
Yeah, I'm excited. It's been a crazy year, definitely a lot of talking points, and I think that we're going to have a lot to go over today.
It's like what a decade we've had this year. It kind of was exhausting. had a little bit of everything, and it was kind of one of those things where, you know, I'm kind of excited for it to end, but I'm also dreading it to end too, because, you know, there's just so much on the table right now, and I'm sure we'll get into some of it, but it's just it has been an up and down emotional roller coaster, to say the least, as far as stocks and the economy is concerned.
Yeah, without a doubt. But maybe we did get a little reprieve for you. I know in your bio we mentioned that you're a West Point grad, and you guys had a pretty big win last week.
Yeah, that was awesome. You always enter those games, with a lot of trepidation, because obviously, they want to win as bad as we do. And it always seems like when you're a fan, right, and you're invested, you always feel like you always get the wrong end of the deal, right? It's always kind of one of those things where you think to yourself, well, if anything wrong can happen, it'll happen to us. And, lo and behold, sometimes, it's law of averages, right? It all regresses to the mean. And we were fortunate because we had a really good team last year, and we blew it. And then this year it was pretty much a toss up, and they managed to find the path to defeat to kick us off the path to defeat. So, it was exciting. And, it was something to watch. And it was, as an aside, my son, he started at the academy this past summer. So
oh, wow.
It was extra strange too, because my freshman year, we tied a very heavily favored Navy team. And, back in the day, they didn't have these overtime rules that they have in college. So it was kind of ironic that had those rules never come along, I tied my freshman year at West Point, and so would he have at that point. So kind of like,
wow, that's like, yeah, that's kind of freaky. Yeah. And because that was the first overtime game in Army Navy history, right?
Yeah, there had been ties, right? But like I said, the ties were just that, the game ended, they blew the whistle, and it was a tie, and that's how it went into the record books. And we had, since the modern, and I forget when they instituted the new overtime rules for college football, but this is the first time it ended in a tie where those rules had to apply.
Yeah, and that for your son, I mean, that can't get more exciting than that for freshman year. Pretty
what
cool.
else is left at this point, right? I mean, it's like
exactly.
How much higher can you go?
How do you top that one? And you hear so much about the connection between West Point or Annapolis, just breeding these leaders, from presidents to big time CEOs or in the armed services climbing the ranks. How would you say that's played an effect on you and what you've done, be it in your personal life or professionally, to where now you are maybe 30 years later, running these huge portfolios?
Yeah, I think what the biggest thing that you get out of any service academy experience, in my opinion, is obviously you get steeped in a lot of leadership techniques, and you get to learn from the premier leadership institutions in the world, right? So that's without a doubt, because obviously the stakes are high. You get commissioned, you go into the Army, Navy, wherever, and you have people that you're responsible for, right? And I mean, so you have a mission you have to accomplish, but at the end of the day, that mission involves people, and it also involves the potential for people to get hurt. And so I think there's that heaviness that comes with that through the entire process as you go through. But the other things that you're taught are things that oftentimes we take for granted. At the end of a resume, it'll say, like, you have leadership and communication skills. Everyone puts that on their resume, but what does that mean, right? So places like West Point, you're taught time management. You're taught about prioritizing things and learning to find alternatives when solutions aren't obvious. Then I think that applies very much so to the financial sort of realm as well, right? Because you basically have, you're dealing with the fog of finance rather than the fog of war on a daily basis, right? There's so many inputs. When you step on a battlefield, you have a plan, but it's like Mike Tyson said, right? Everyone has a plan until they get punched in the face the first time. So what happens? You get on a battlefield and you had your plan. Well, it doesn't work. You go someplace and there aren't the people there that were supposed to be there. So you have to improvise. And it's the same thing with the markets. We have so much information pummeling us that you have to be sort of organized, prioritized. You have to see what the end goal is at the end of it, and so it helps you focus on the task at hand. And you try to do it in the best way you can, using the inputs that you have. But I think learning flexibility, dealing with adversity, I think those are all important sort of touchstones that you should have. And I think it's funny because I was an infantry officer, right? So you think, like, you get out and they're like, well, what are the civilian applications of jumping out of airplanes or digging foxholes or laying down fields of fire? Well, there aren't any. But the fact of it is, the ability to organize and lead people to a level and a standard and to accomplish a mission should be applicable in all aspects of business. So that was kind of why that helped, all that background I lean on to help me in the management of portfolios and manager evaluation and dealing with clients and their goals as well.
And that's brings me to another point, like that experience that you had at West Point and thereafter in the Army. Does it make things in a way seem easier, as you go through life and you take on these other positions in finance? Does it maybe bring the stress level down of leading men into battle versus maybe leading men and women, of course, to manage, portfolios and people's life savings?
Yeah, I mean, I think anytime you have a sense of perspective in anything you do, it helps deal with a current situation. So let's put it this way: if you've never been under stress before, you don't know how you would react. There's a lot of there's both the physical and the mental aspect of reacting to stress, and studies have shown that people don't handle it well, right? But for example, at West Point they have when I was there, they had what's known as plead boxing, right? Because some genius psychiatrist back in the 40s said, if you put young men in a ring and they beat each other, they're going to experience stress. I'm like, yeah, I would imagine too. If you're getting punched in the face by somebody, you're probably going to experience stress. So then that triggers sort of that fight or flight, reflex. And if you've never been there, I mean, I'm always reminded. I mean, do you remember that book, The Red Badge of Courage? And in the very first part of the book, that Stephen Crane wrote, where the antagonists they run in battle. Why? Because they've never been in battle before, right? So they've never had that stressor. So I think, to me, like, the more experience that you can heap on folks early on, it gives you an opportunity to just sort of step back and say, oh, well, I felt this before, and this is how I reacted, and this was the outcome. So how do I fix the situation without getting my emotions in the way or reacting rashly. So yeah, I think it lays a very nice foundation. Case in point, I mean, being cold and wet. I mean, if you've never been cold and wet, you're going to be behaving a different way than you had experienced it. I mean, I'm not saying it's comfortable at any point in time or
Yeah.
hungry, but at the end of the day, it's like, okay, so it didn't kill me. And, I figured out a way to get through it. And so, that is applicable to situations where, markets are behaving crazy or irrationally and people are throwing. And I think, we never give enough due to the emotional aspect of the markets. I think there's a huge emotional component when we see markets down 800 points or up 1,000 points, or things that don't seem to matter or make sense in an academic way all of a sudden happen in markets. And I think if you don't have a way to sort of measure your internal your internal response to that stuff, you can get caught up in it.
Yeah, and as you're just saying all that, it seems like in today's day and age, like a lot of that is almost the exact opposite. And I talk about, I have a book coming out in February next year. And one of the things I talk about in education and higher learning is there's often touted, a comfortable place to learn, a comfortable place to grow. And it seems like, for an entrepreneur, certainly it's almost like an oxymoron where you're hearing comfort and growth. It's like if you try and make everything perfectly comfortable, how much growing could you be, doing when you get out into the real world and have to encounter a lot of these variables like you talked about?
Yeah, well, why would you want to leave comfort, right? I mean, and
Yeah, exactly.
at the end of the day, struggle. I mean, that's how we got out of caves. That's how we, stopped wearing animal skins. That's how we discovered fire and the wheel and all these other kind of things. It's all about moving forward, right? And and all of that is from where? It's from a sense of thinking that things could be better. Now, you could define things could be better as a form of discomfort, but if you're perfectly comfortable and happy with everything that's going on around you, why would you try to achieve something different? So, yeah, I mean, I kind of find that it's a bit of an oxymoron when you talk about the things that you mentioned. I think college and education should be uncomfortable because you should think to yourself, what more can I learn? How much better can I be versus, hey, you know what? It's all good here. I've got everything I need. Why do I need anything else? So, it teaches a sense of complacency that I think is becoming more and more rooted. And it's unfortunate because, I think that's going to, impact how we progress as a society and how we hopefully become a better society if we don't have agitators. I mean, you look back and you look at, some of the great politicians and the Fords of the world and all these other people and the JP Morgans and all that. And then, what do we have today? We've got Elon Musk. I mean, that's all we've got, or maybe a Jeff Bezos. And it's like, it seems like we're producing less of these type of people that sort of challenge the norm because we're just too happy with what we have and we're willing to accept with what's available.
And do you see that changing? I mean, and this kind of dives down a little bit of a rabbit hole here, but I think it gives context to the global economy when you hear so much of, now it's down to the US and China and these two superpowers that are kind of guiding where the future will go. Do you think there's a sense of complacency right now, or is that a lot of hype that you're hearing about just young people and TikTok, or is that something that actually does need to get fixed?
It's funny you mentioned that, right? Because I think it's both. I mean, I've heard, and I don't know whether this is anecdotally how accurate this is, but TikTok in China, they have like physics videos and they have science videos and they have, all of these sort of like, a technology being used for the good and for the betterment of society. And in our country, our version of TikToks is, people are twerking and doing stupid tricks and, mogging, I guess, to borrow a kid's phrase. I don't know why that is, but in a lot of ways, it's easy to get, involved in conspiratorial type thinking. But let's face it, look, boil it back, step back from this thing. China is an up and coming world power. Okay. We have been the leader in the world for the past 70 years, right? Since the end of World War II. Do we want to give up that mantle? China sure as heck wants to be number one, and it wants to, hold sway, and we're in the way. So, you can get really, really dark and start going down places and saying, well, they're actively trying to undermine our culture, maybe. But if you know that, then why aren't you doing something about it? Why are you, sort of complicit in that aspect of it, of letting it, erode? I mean, if you see something, in the garage that's rusting, why are you just leaving it there to rust? Why don't you take some Brillo pad to it and some, oil, and get the rust off and get the tool working again? So there's some of that, but I mean, some of it is active on the part of just competition between cultures. We've had that all along, right? From back from ancient times, where cultures would clash, whether you had, the Macedonians, invading the Persian Empire, and there was a clash of cultures there, and that went one way, all the way up to modern day. So there's going to be competition between cultures. My point is why create self-induced weakness, which seems like what we're doing. And I think that's rooted in what you just talked about a minute ago about comfort, right? I mean, it's like, hey, we're happy, we've got everything we need, and we're willing to entertain things that we wouldn't had we been struggling, right? So had we been looking for something better. So a lot of, without getting too philosophical, it's a lot of it is just, perspective, right? What do we want to do? And there's a contingent in the country that wants to, have this Coca-Cola moment, right? I want to teach the world to sing and share a Coke kind of thing. I don't know if you're too young for those commercials, but then there's another part that says, you know what? Well, we're in this world where we just crested 8 billion people, and everyone's fighting for the same resources, for the water, for the oil and the minerals and all that other stuff. And do we want to lower our standard of living here in this country and bring everybody up, or do we just want to, hey, we're winning the marathon, and I don't really care about the guy who's 5 miles behind and struggling? I don't know. I mean, that's where I think we are. But I think if you look at China, they're not worried. They're not having those discussions. They're like, what do we need to do to progress, and how do we do it, and at what and which way can we? So, you also have to consider your opponent, because not everyone's got the same approach to how they want to win the game, or whether they just want to have a good time playing the game, or they actually want to win the game. I mean, that there's a difference in that sort of perspective.
Yeah. And there's so much there, I think, to kind of dive into. But one of my big takeaways is, as we discuss this, and that I've talked a lot about in these debates, is I think China has the ability in a way to kind of grow that society organically or internally, because they're communists. They can control what TikTok is going to show, where we don't have that ability. If we want to show these ridiculous videos, more power to you. And while that gives some freedom, it also gives some negativity. But I think that our silver bullet has always been, at least what I've seen from my research, it is lending a lot of itself to immigration, where not that many people are immigrating into China. But if you look at America, every single year, it's not even close that we're the leader in influx of immigrants coming into America. And so I feel like if we always have a bit of a brain drain, competitive advantage against the rest of the world of new people here that are ready to work their tails off or bring a new skill set, that's where I think, we don't grow stale. I think that's kind of the little, piece of magic that we have that some of these other countries don't have.
Well, and we go back to what we talked about, discomfort. Why are all these people coming from here? They're unhappy with where they are. They're uncomfortable, right? So we have a nation full. I mean, I'm sure, if we were to go deeper, a guy named Siomades and a guy named Caderna are probably not, Mayflower deporters, right? I mean, we all have people that came from other parts of the world, and they basically came here because they felt that they were getting a raw deal wherever they were. And those people tend to want to progress, right? They want to change their discomfort into comfort. And so, they create businesses, they create opportunities. So you hope that that's the shining model, because at the end of the day, you're right. I don't see anybody beating down China's doors to immigrate there and partake in that lifestyle. It's an authoritarian, heavy-handed surveillance police state. Okay, if that's your bent, then I'm sure they would welcome you with open arms. But I'm always reminded of those videos where they would have, like, the Vietnam POWs or the Korean POWs, where they would sit there blank staring into the camera saying how bad the United States was. And that was all coerced, right? So that, to me, when I hear nonsense like, we've got all of these cultural problems and racism and whatever other things, you want to throw out there, why is everyone trying to get here then if it's such a horrible place, right? So
Exactly.
to me, I think you're right. I mean, at the end of the day, it's like we keep getting fresh blood in here with fresh blood, but uncomfortable fresh blood, right? People that want a better way. And so they're going to focus on making things better for themselves and their family. And in that process of progressing to make things better for themselves, they make it better for the rest of us that are here, because they bring new ideas and new ways of doing things. And ultimately, that's how society progresses. It doesn't progress by taking things away from people and collectivizing them and making a system where everybody's just a number and gets their rations from the government, and you're told where to go and how to go there, and versus, hey, you know what, I just created something, you can too, let's get there, and you have the opportunity. And I think that's the key word, right? More than anything, is we have opportunity in America to do whatever we want. You don't have that in the same way in other places in the world.
Correct. Yeah, and I think that goes back to, a free society has its flaws, but a free society is the one that's winning. And hopefully it stays that way. And I know there's a lot of different directions we could take this, but maybe a segue back into some of the investing side of things. Obviously, that's your bread and butter right now as a chief investment officer. Do you get into a lot of these global affairs and really paying mind to kind of the socioeconomic environment when you're out there building a portfolio? Or do you not pay so much mind to maybe current events and look more at the raw numbers?
Yeah, so I'm more quantitative in my approach to portfolio management, right? So I use computers and models to put together my portfolios. I don't really look at long-term sort of societal structure and stuff. I run my models through computers, and I'm really agnostic of whether I use IBM or I use Microsoft. It's whatever pairing of those securities make the most sense for me to achieve my objective. Obviously there's long-term trends. For example, I'm not a huge fan of the international marketplace right now because their economies aren't doing as well. That's not a comment on how they run their countries or how, say, the EU functions. It's just that, you look at things like GDP and you look at, economic indicators, and ours are just better. So, when it comes to putting a portfolio together, I may say at this point in time, it makes more sense to be more US centric versus, say, going back to a traditional, allocation to international stuff. So I look at stuff like that, but not necessarily anything as far as, what kind of news they're making as far as, how they're running their country, unless it's making an impact on the economy of that country and whether it's attractive to me or not.
Okay. And so right now, is it safe to say you do a lot of your work based on algorithms, and is that where you're generating a lot of the numbers that kind of guide your decision making?
Yeah, my specific portfolios that I manage in-house, but just as a reminder, we have nearly 20 billion in assets that we manage, and we also use external managers. So they each have their own way. Some are fundamental, where they're looking at the financials of each company, and they're making a bet on whether they like Tesla or whether they like GM or something. But or there's a multitude of strategies, right? And we try to offer that to our clients because not everyone is going to be quantitatively oriented or fundamentally active portfolio management oriented. Some people may like, black boxes where they use certain data inputs as well. Some people like tactical managers. Some people are more of a buy and hold approach and just want, your standard 60-40 model, and they're going to not touch it for 20 years. So we try to offer everything, but my internal strategies, which is about, I don't know, I'd say maybe a fifth of that 20 billion are focused that way.
And what led you, like over the course of your career or right now, to the point where you're more guided by the math per se, than maybe taking some of those other approaches that you just alluded to? Was there like a tipping point where you're like, this feels right, like it gives me a certain level of confidence that I think that this is a smarter way to go about it?
Yeah, I think, listen, I think data is important, and I think data is also, over time tends to bear out. I mean, one of the metrics I look at, we had a horrible year this year in the stock market. If you look back nearly 100 years, the stock market is up 74% of the time. So people that soured on the stock market this year are apt to miss out the next 3 to 4 years, because the market will rebound, right? So that's just one sort of anecdotal thing to think about. But also it's that structure, right? I mean, a lot of it is we are who we grew up as, right? So as I grew up, like we talked about West Point earlier, right? There's a methodical approach, right? There's planning, there's structure. So that inherently is more attractive to me than, because at the end of the day, when you look at a fundamental manager, for example, for my personal investing, is I don't care how much data they throw at you, at some point in time, it's still going to involve a subjective decision. So that's just my bent. But again, it's not everyone's cup of tea. So to me, it's like I'm apt to say, look, I'll shrug my shoulders when the model doesn't work and say, you know what, it didn't work this year, but it doesn't mean it's not ever going to work again. But when somebody buys a dog stock in their portfolio, what's their explanation? Well, we looked at all the numbers and it didn't do well. And then you have zero guarantee of whether that's ever going to, work out for you again. So, it's 6 of one, half dozen of the other, Brian. I mean, it just depends what you should. And I would say, as an investor yourself, you should have a philosophy too, right? You just shouldn't listen to what you're seeing on financial television or reading in the papers. I think it's incumbent that we need to get educated as individual investors and say, this is what makes sense for me. And, some of it could be like ESG stuff. Maybe you care about that stuff more than you do something else. And that's fine. I'm not saying there's anything wrong with it, but at least, you're making a commitment versus just being a receptor of everyone else's hype, for example. I mean, I could talk rings around people about how much I love quantitative investing, but that's me because I'm passionate about it. So my point to people is, you need to get the passion for your style of investing. What makes sense to you? What are your outcomes that you're looking for? And does that get you excited? So I think, I think, again, I'm all about accountability. And I think, everyone needs to basically, have a plan and be certain in their plan, and then find the pieces that help you execute your plan.
Yep. And I think that's at the core. A lot of what I preach is you got to have a plan. You got to have a philosophy, because if you just kind of go with whichever way the wind blows and follow the latest fad, you're kind of just betting on luck at that point, because you might leave a good strategy for a bad strategy or vice versa, but they're all just snapshots in time that, some are better than others. So I think that's a good piece of advice there. And one of the things I wanted to ask you about, just kind of taking a step back to look at this year of course has been the year of inflation, and what's the Fed going to do about inflation, and then the trickle down effect that's having, to investors. So what's some of your take now looking forward to 2023? As we air this episode today, as we discuss, it's December 15th. Just yesterday, the Fed came out with a 50 basis point rate hike. What are you thinking for 2023? Not to put you on the spot, but a little crystal ball there, if you will.
Yeah. So what was interesting is, the market was really hyped up to hear that the Fed was going to lessen the pace, right? So we had 4 consecutive 3/4 point increases, right, in the Fed funds rate. And then yesterday they raised by 50. But the challenge is what the next step that the market is really looking for is when's the Fed going to stop, right? And so, prior to yesterday's announcement and the subsequent press conference was that, the Fed would go 50, which they did, and then potentially only do another quarter in the first quarter of next year. That does not appear to be the way Chairman Powell is thinking about it. He's thinking about continuing to raise rates, not at 0.75%, but some lesser amount, but for a longer period of time and keeping them up there in order to just sort of squash inflation. So that's what kind of markets are reacting to now. It's kind of like they like the slowing of the rate increases, but they're really looking for an end. And right now, the Fed, as of yesterday, has signaled that they are not going to lower rates until 24, and they're also going to probably raise. So we're at 4.25 right now in the Fed funds rate. They're probably talking about going up to about 5 or 5.5. Which, how they do that, 25 in January, 25, 50, who knows? But at the end of the day, you're still about 1.25% away from any kind of conversation of them stopping. And, again, it's higher rates are anathema to the stock market, right? I mean, you want low rates because it makes it less expensive to borrow, and you could put more money into the business. And then obviously as rates go lower, fixed income isn't as exciting as an option. So more people will gravitate towards the stock market to seek returns. So higher rates are bad for the stock market because it makes doing business more expensive, and borrowing costs go higher. So the longer that persists, the more logic would dictate that the stock market would stay in a funk. So,
and if I could just interrupt you really quick on that point, Tom, I have two questions for you. The first one, we talked about emotion before. Do you think some of what Chairman Powell is saying and said yesterday has to do with just how far off the Fed was in 2020, where inflation in the summer of in 21, inflation was already creeping up pretty quickly when they kept just telling us it's transitory, it's nothing to worry about, before it even became a talking point. Do you think some of it is they just kind of got caught with egg on their face, and now he's taking this tougher stance of, I'm here to do whatever is necessary to beat inflation, because just a year ago he was busy telling everybody, don't worry, inflation's going to pass right through the economy. Is he kind of just doing an about face in a way?
Yeah. So for, again, without getting too deep as far as conspiracy goes, I can't believe that the Fed and intelligent people like they have at the Fed would have ever bought into that transitory argument. My theory, and again, it's hard to prove, but you had an administration that was spending a lot of money. They liked low rates. Chair Powell was up for re-election or reappointment, if you will. And so from that standpoint, are you going to do the thing that, is not going to get you reappointed? So I think a lot of it, and again, human nature, right? He basically went along, and Janet Yellen, people like that too, were calling it transitory. And it's like, listen, guys, you know better than this. And so the fact of it is, he waited to raise rates until literally the month after he got reappointed in February of this year, and literally in March he started raising rates. So it's like, I can't imagine.
Convenient.
Yeah, I can't imagine that he just woke up one day and said, "Oh boy, I've been wrong all along. My goodness."
Yeah.
No, it's and then this is where we get into the emotion, right? And we get into the pettiness, the pettiness that can come with people that do things for self-serving reasons. So, okay, so let's assume that we got to that place. Well, then the other thing where the emotional stuff comes into the fact is the market didn't believe that Jay Powell had the backbone to stick it out. So if you remember, we had a rally last June because it was like, the Fed will raise 75 basis points and then they'll pause. There was that conversation the entire early summer to midsummer up until he gave his speech in Jackson Hole, where the market was like, we don't believe him. We don't think the Fed's going to do it. We don't think they have, they don't have the backbone. And so they'll just pause. And so until he stepped up to that mic, he gave that infamous 8-minute speech in Jackson Hole that says, no, damn it, I'm going to do this. Then we had that nasty little sell-off in September. But then again, it was the same thing. It's like, okay, the next iteration where emotions come into play is the market says to you, well, once we start seeing inflation peak, once we start seeing it trending downward, they'll have every opportunity to just, back up. So then that conversation started to be had again. When are they going to pause? When are they going to stop? And, we have had a lessening of inflationary pressures. And if you want, I can get into my theory of why we have more so than just actions on the part of the Fed. But, now they're saying, well, we went from 9.1 to 7.1. That ought to be enough for the Fed to just say, okay, we're going to stop. And he's looking at history, and he's got a very, very good guidepost, mile marker for history, which was the late 70s, early 80s, where they were doing this nonsense. That particular Fed was doing this nonsense of like, well, once we see 2 or 3 months of strong positive data, we'll just stop, and then inflation would rear its ugly head again, and they were back on that carousel, that rate increase carousel. So he's singing like, I'm not going to get fired because I have my job for the next 4 years or whatever it is, and I'm just going to drive this thing down to 2%, and the heck with what happens. My issue with that thinking is that I don't think he's the only player on the driving inflation train. So that's kind of my tease if you want to ask me what I think it is.
I do. Yeah. No, I definitely want to get into that. And so there's so much to kind of digest right now, but maybe two things I want to hit on, and don't let me forget the follow-up. I want to ask you, when you create these models, these algorithms that help you pick your investments, about don't fight the Fed. So I want to come back to that in a minute. But before I go there, right now, with a lot of average folks out there, maybe they don't consider themselves investors. They're hearing in the news that good news is bad news and bad news is good news. And it seems so contradictory, like, oh, if we can just get unemployment to creep up, then the stock market will get really happy, and maybe, Fed chairman will slow down his rate hikes. And so you're hearing these different things. And at what point is it like, okay, the bad news is actually bad news, like enough about what they might do with interest rates in the stock market, but we just don't want to see Facebook or whoever laying off tens of thousands of people, like that's actually a bad thing for the economy?
So the bad news is bad news is my sort of simple answer to that is people spend a lot less money when they don't have a job, right? And that's the challenge that I think the Fed faces is, we've got all these openings and we've got a really low unemployment rate, but I don't know that there's an actual, one-for-one connection. Is a person not working going to fit that opening? I don't know. But at the end of the day, if they drive up unemployment, that means actual people are going to lose jobs. They're not going to spend because, you're obviously going to pull your horns in when it comes to, any kind of discretionary spending. And, your personal economy goes to zero. And we're not talking about a GDP decline of 1 or 2%. I mean, I don't know anybody whose personal economy goes from, 100% to 98%. It goes, you lose your job, it goes from 100 to 0. Or, and damn well that unemployment and whatever other kind of benefits you get nowhere near replace most people's salaries. So that's my fear, is that, when you start seeing that unemployment rate creep up, and again, remember, they started raising rates in March. Okay. This time last year, they were saying they were only going to raise 50 basis points for the entire year. And they've raised 425 basis points. Yeah. Right. And think about the last 4 whammies that we've got, starting back to the summer, the 75ers, those haven't worked their way through the entire system. That's like a huge, huge wave that still has to play out. And let's not forget the balance sheet that the Fed acquired throughout, when they did their quantitative easing. They need to unwind that. And that's kind of stealthy. It's not a very high profile. Hey, I'm going to walk up to the mic and say, ladies and gentlemen, today we're raising 50 basis points. They're doing that in the background, and that's impacting interest rates as well. So, I don't think the economy per se has felt the full effect of
And
all
doesn't
the
that
grants.
kind of support that whole idea of like, why doesn't the Fed just like take a beat and see what's actually happening rather than kind of keep the foot on the pedal, before we even get to see the trickle down effect through the economy?
Yeah, because we can get back to that emotional thing, right? Because that means the market's going to shoot up again because it is kind of like a coiled spring. It's waiting for that language. And once you get that language, the market's going to go up. There'll be a little bit of a wealth effect. And, it's going to say, see, we waited out the Fed and we were right. And I think that's where the emotions come in for somebody like Chair Powell. I don't think it's necessarily a logical sort of reaction. It's like, damn it, I'm gonna crush the stock market. I'm going to crush the home market or the mortgage market. I'm going to crush the unemployment because I keep telling people, everyone keeps thinking that the Fed is some sort of like precision instrument, some sort of laser guided scalpel. It's very blunt, right? It's one of those, those big switches, at the movie theater where it's like you just slap it down and up. That's
Yeah.
all right. Yeah, it's very blunt. So, he's got that one instrument that he's wielding, and it's not just going to affect the stock market or the jobs market or the housing market. It's going to affect all of it at the same time. You're literally going to shut off power to all of it. So, if they persist in this aggressiveness, it's going to run us into a recession. And then you will have, people losing jobs, people defaulting on homes, falling behind on credit card payments, et cetera, et cetera. And that's why I think it's in my view, the logical thing would be like, listen, guys, we've raised 425. We said we were going to do 50. So that's way more than we've ever done. It's going to take several months for this stuff to percolate through this economy. Why don't we just sit back and wait, with the caveat that if we don't see inflation continue to drop, we might have to move again. But he doesn't want to lose that momentum because he realizes that, once that initial round of pain works its way through the economy, the impetus to start giving more pain is going to be he's going to face a lot of pressure not to do
That's
more.
that is true. Yeah. I mean, it's going to be almost impossible to raise rates if people can't put food on the table.
And if you have people out of work, Brian, think about it. The impetus isn't going to be necessarily to just restart raising rates. The impetus is going to be to lower rates, to try and
Sure.
stimulate the economy.
Sure. And so I feel like the conversation, all this in 2021 going into 2022 was kind of let's try and pretend it's not so much of the trillions of dollars of stimulus that we pumped into the economy, the very long standing enhanced unemployment benefits. It's like we tried to kind of brush that aside and said it's because of the supply chain. It's this darn supply chain that's given us all these issues. And that's why prices are so high. You don't hear so much about the supply chain anymore. Is that something that we've kind of worked our way past, or was that perhaps blown out of proportion in a way, being kind of the scapegoat for all this?
Yeah, I think there was a lot of excuses that basically masked the fact that we just had a ton of money out there. And what you had was people that were incentivized not to go back to work initially after the pandemic. And we still had the same amount of demand, right? So yeah, you had the glitches at the ports because of, pandemic sort of, safeguards and things like that, or quirks like, California saying that you can't operate a diesel in our state, and you got major ports in, Long Beach, and then somehow it's got to get to the interior. So there was that type of stuff. But I think fundamentally what it was there was a lot of money that was dumped into the market or into people's pockets, and we still had the same amount of consumption demand, right? So you had less people making stuff, but you had the same amount of people using and buying stuff. So that was going to naturally permeate its way into, higher prices. It's just the way it works, right? It's basic economics because, demand was going to outstrip supply. So now we're seeing where those excess savings, or people have gone back to work and are making that, people that make stuff aren't stupid. They figured out a way that, hey, we need to make more stuff because we're selling it at a higher price. Why not sell more? And so as a result, prices came up, supply sort of, came back online. The pandemic sort of safeguards or restrictions have been lifted to some extent. So, the shelves have everything. It's just that, at the end of the day, it's expensive because we still have people that were, spending that money. And you see it in the sense that, the savings rates had shot up post pandemic. And now people are working through their savings and actually tapping credit to try to keep up with their lifestyle.
So what do you think happens now, going all the way back to kind of where we started, looking forward to 2023? And, we're not going to hold you to this. We're not considering this, direct investment advice or anything, but do you see a recession in 2023? Is that actually inevitable?
I mean, on the path that the Fed is on right now, I believe it is. And, whether it's so I'll lead with this caveat. I think we have been in a recession. And it's not maybe a technical economic one, but I think it's been an emotional recession, which is, since probably the beginning of this year, right? I mean, we'll let the historians decide when the recession started, but think about it. I mean, wages aren't growing as fast as inflation. People were paying top dollar for stuff, that they couldn't find what they wanted, and then they were paying for top dollar for stuff that was sort of a surrogate for what they wanted. They're blowing through their savings. It's getting to the point where food inflation is high. Sort of all the basics are still high. Their wages aren't keeping up with it. So I don't know how that doesn't. You see it sort of in consumer confidence, right? It's sort of like wears on your conscience. So when an official recession actually occurs, I don't know, maybe the middle of the year. But I mean, all of these, yield curve inversions that we're seeing, they're almost uniform, right? Where short-term rates are higher than long-term rates. And we have not had a recession every time we've seen these yield curve inversions, but there's never been a recession without these inversions, and they're all uniform, right? And so there's a big, huge red light that's blinking out there that's saying we're going to have this. And maybe it comes, in the spring or early summer, when the full weight of all of these sort of monetary tightening and higher interest rates, impact the economy, or just, to me, 70% of the economy is driven by the consumer. So it'll be interesting to see how we hold up during the holidays. But I have a feeling, at some point in time, people are going to throw in the towel. I mean, I don't know about yourself or for me, but I'm not over the top with the holiday season buying and all that kind of stuff. It's nor like overly frugal, but I mean, it's kind of like we got everything we need, maybe one or two extra things, but it's not gangbusters. So I think when people get to that point, they kind of just, shrug their shoulders or worse yet, say your neighbor loses their job, right? I mean, you look at that person, you see that family struggling. It's like, what are you going to do? Go out and buy a new car? Or go to on that 2-week vacation and rub it in their face. So I think there's some of that too, where there's a societal guilt, collective guilt, where people say, well, you know what, maybe I should that could be me in a month or 6 months.
Yeah.
So
yeah, that's interesting. A lot of people don't talk about is kind of that momentum and people that aren't directly affected kind of blending into the people who are affected. And one of the things you did point out is, we'll let the historians debate is if it's a recession or not. And I think that's a good point, is sometimes recessions aren't identified as a recession until it already passed. So with that said, is the term recession that we hear so much about, is it kind of in a way much ado about nothing, where if it does come or it doesn't come, it doesn't matter. The economy kind of is what it is. The stock market's going to do its thing. And furthermore, if we look historically, usually the sharpest downturn in the stock market, at least, is leading up to the recession. And then once we're actually really in the thick of it, of this terrible recession, usually that's when we see a pretty nice rebound out of the stock market. So should people be that worried about it? I think a lot of just average folks out there think like, okay, one day they're going to come on the news and say, hey guys, it's January 24th and America's in a recession, and then the world's going to catch on fire. It's not so black and white like that, is it?
No, it's actually a disconnect in a lot of ways, because a lot of the stuff that leads up to a recession is a culmination of past events that sort of push us over the edge. The stock market in a lot of ways is an anticipatory instrument, right? So they're thinking about 6 months down the road next year. So in a lot of ways, when you see a bad stock market like we've been seeing this year, it's in essence signaling that we're in for some tougher times up ahead. So when that actually comes to fruition in reality, and we're like, oh my God, look at that. We had our V8 moment, right? That we're in a recession. Okay, well, you turn around and then you're like, well, my neighbor doesn't have a job. The collection people keep calling about my car. Why is the stock market ramping up? Well, because they realize that we've hit rock bottom at that point. So to me, I always think of it as I think of Benjamin Graham, who was one of the fathers of value investing, right? He said on a daily basis, the stock market is a voting machine, but in longer term, it's an adding machine, right? So every day we get sort of a peek into where we think the economy is, so up or down, but then over time, and again, I allude to what I said earlier, 75% of the time, 74% of the time, you're going to be up. So to me, it's like you should always be goals focused, first and foremost. Don't worry about the actual numbers. It's when we talked about accountability and getting yourself right as far as, your investment philosophy and what you're trying to do and having a plan, that plan should include goals. What is it that you want to do, right? And don't worry about the fact that I need to get 5% every year, year after year after year. That's not how it works. It's a question of like, do I want to send my kids to college? Do I want to buy a boat? Do I want to buy a vacation home? Do I want to retire when I'm 50? Whatever. Those are goals. And then you should structure your investments the same way. And to me, in my opinion, regardless of what we saw in the market this year, I still think that's one of the best opportunities you have to make those goals. And your biggest friend is not only the cumulative effect of the markets over time, it's time itself. So I know your audience tends to be younger. To me, it's like the sooner you can get in this, whatever you could put into it, put it in there and let it work for you, because you don't want to be 62 years old waiting for your investments to hit the jackpot on your investments, because then we get into that other problem of where people make emotional bad mistakes because now their back's against the wall. So
yeah, no, well said. And I think just another question I wanted to throw at you, because it's kind of like you have two sides of the coin here. You could boil it down to where a part of people out there will say, don't ever bet, on the end of the world, because it's only going to happen once, so you just kind of take pause, stay the course. And then you have the other folks out there who are going to say, hey, America has $32 trillion of debt outstanding. Our debt to GDP ratio is through the roof. If things hit the fan again, if there was another coronavirus pandemic, can we just flip that switch and throw $3 trillion again into the economy, in a heartbeat? So do we lose some of those levers to pull? Like, are we kind of losing some of our armor as an economy? Are there things to be worried about in that regard? Or is this just all a part of just, we've always built ourselves on debt, we've always inflated the economy, and we'll keep on doing it?
Yeah, I can see both sides of it. I mean, there's the doom and gloom that, we've got. Well, think about it. There was doom and gloom when we had 20 trillion in debt. Now we've got 30. The way we get out of that, underneath that mountain of debt, is through growth, right? And innovation and productivity. It's not going to be through austerity measures and things like that. But at the end of the day, I mean, some of the spending that occurred during the pandemic was good, and that it saved a lot of industries and people's jobs. And then there was a lot of it that was just gratuitous pandering, to select special interest groups. So, I mean, do I think so long as we can keep printing money and there's faith in our economy to back it up, I think we're always going to advance. But I don't know what that magic number is. Is it 30? Is it 35? Is it 50? Is it 100 trillion of debt? I hope not. I mean, I hope we become more responsible as we're going forward. But at the end of the day, like I said earlier when we talked about immigration, this is still the best place in the world, the best deal that we have to get ahead. And so long as we maintain that forward-looking optimism and we innovate and we transition and move on. I mean, I always tell folks, we didn't leave the Stone Age because we ran out of stones, right? We found a better way. Right? We found a better way, right? And so whether it's green energy or smarter fossil fuels or whatever, that's one thing. Or whether it's a whole different. I mean, we've gone from, think about where we were post World War II, where we were a manufacturing economy. Now we've pretty much transitioned to a service economy. I don't know what the next step is, but it's all a tip of the hat to our ability as a society and a country to allow all of these uncomfortable people to come over here and figure out ways to do things better. And I think that's ultimately what's going to slay this, fiscal beast is, having a government hopefully that isn't spending as much on things we don't need, but also growing the economy to the extent that, we can eradicate a lot of that debt without it impacting us and running us into the gutter.
And so, Tom, maybe to put a bow on it here, we've talked about everything from going green to, like you said, we used to be manufacturing economy. Now we're service economy. We got inflation, the Fed, we got a million different variables and innovations and things changing. What, if any, of this has changed your take on investing this year? Or has it not changed at all? Was your philosophy, your models the same in 2021 as they will be in 2023?
Yeah, I mean, look, at the end of the day, the future tends to, doesn't repeat itself, right? It rhymes. So, no, the tactics I've used are, born through time, right? So I've made tweaks. I'm not gonna lie to you, but it's not like I went to just, bought all CDs because CDs now are yielding 5% and the market was down 10. It's like I have a discipline and I apply it, and over time my discipline works, right? And so from my standpoint, I think what I would also caution listeners against is be mindful of the portfolio, approach that tells you that they're going to get it right every time, because that never, market timing is one of the biggest problems that I think investors have, is that it's a two-edged decision. First of all, you got to know when to get out, you got to know when to get in, and it's not about market timing, it's about time in the market. So when you think about that and you look at that, sort of approach is, I want a manager who tells me what they're going to do and they stick to the discipline. And so that's what I strive to do is I'm disciplined. I mean, yes, I'll make tweaks, whether I'm a little heavier international because, the numbers seem to favor that, or less so, or more US or more value or more growth or whatever. But at the end of the day, I'm moving in the margins, and I don't want people to buy something that I manage and then turn around and find out that, holy cow, this isn't what I bought into. You've changed 180 degrees, and that could cut both ways. That 180-degree pivot might have been awesome, and I might have hit the ball out of the park, but by the same token, you're just as equally liable to blow it. So I've changed given the data that's available and reacted to the current environment, but I also haven't abandoned my discipline. So, I mean, that's kind of, I hate to be cheeky, but that's kind of saying it both ways, right? It's like, you want a tiger that's going to be a tiger, but you don't want the tiger changing its stripes either.
Yeah. And maybe just a tiny follow-up to that, because I often go back to, Warren Buffett. I know you mentioned his mentor and Benjamin Graham before, and Berkshire Hathaway, if ever they've shown themselves, this year was a pretty good year for them, relatively speaking. But one of the things that Buffett took a lot of heat for a long time was his being averse to tech, where tech was just roaring for so long. And he's like, I don't want to dabble with that stuff. I don't understand it. I only invest in what I know. So kind of to that point, I know you have a philosophy that you adhere to. What's your take maybe on things that are new, per se, crypto or green? I mean, going green has a little more history than crypto, but are these things that you're open to, or how do they kind of find their way into a longstanding philosophy like yours?
So what I think about is, the way I approach it is I think about it being open but skeptical. So
Okay.
you have to, the problem that I have with new stuff oftentimes is we tend to accentuate everything that's positive about being new, right? It can do this, it can do that. Imagine this, imagine that. Okay, great. I can, and I'm open to it. But I'm also have another part of me, and that goes back to being an officer, right, in the Army. It's like, what can go wrong? And so that was the stuff that, whether it be crypto or technology, and we didn't really talk about crypto all that much, but it's similar, right? When we talk about technology, like, yeah, there's a lot of great stuff with social media and TikTok. But what's the dark side of that, right? What's the potential? And we kind of see it with TikTok, but we could kind of see it with crypto too. So, my approach is caution, openness, and caution and skepticism, and I like to consider what the alternatives are, because we know in this world it never goes according to plan, and that's what you should have in the back of your mind as an investor, is like, say, listen, I get it, but at the end of the day, what if it doesn't go the way I want it to go, and what are the potential pitfalls, and can I live with that? And so then if we get into a risk mitigation sort of scenario, right? It's like, I see all these positive things, and then I see all the things that could be negative. So I've done that math, right, internally. And now I get to the point, well, am I willing to risk some of the bad things in order to win at some of the big things? And that's where I think, sometimes people fall down when it comes to investing.
Got it. That's a great little tip there. And so I know we've covered a lot of ground here, to say the least, Tom. I really appreciated some awesome insights. Do you have anything that you might want to leave our listeners with, or that we didn't hit on?
Yeah, I mean, listen, if you've got time, it's time in the market. So to me, it's like, just let let history and probability work for you. I know they're kind of boring subjects. I know my son complained. I was actually I can't believe that he complained that the class he liked the least at West Point this fall was history. I'm like, I loved history, right? So he's like,
Yeah.
I can't stand it. I don't like memorizing all those dates, blah blah blah. Like, okay, right. But to me, like, that's what I would urge investors, is like, look at the long-term trends, invest for goals, invest for the long term, right? And I mean, I have a philosophy, and I talk about this with folks, is because you see those big charts, right, that have like here's what the Dow did from like 1919 to today, and I'm like, well, I'm not 102 years old, so
Yeah.
that doesn't pertain to me. My philosophy is this: you should invest as an institutional investor, meaning invest into perpetuity, but you also should invest as an individual, and you should know when on that line you should get in, get out, de-leverage, de-risk, right? So you should always structure, if you're a 25-year-old, you should structure your portfolio the same way the Harvard Endowment Fund does, or any long institution that is investing for the longer term, forever, right? But when you start moving down that path, think of it as a train, right? You get to pull the lever of when you want to get off that train. So that's sort of for my philosophy is, don't invest for the moment, invest for the long term, but you should also know what moment you're in and alter your investments as you move down the tracks. So that's what I would say to folks: goal focus, invest for the long term, but you're the ultimate, sort of conductor of when you want to get off the train.
Got it. Got it. Great advice there, Tom. Really appreciate it. So, ladies and gentlemen, I want to thank everybody again for tuning into the Caderna podcast. I'm your host, Brian Caderna. Today, we had the pleasure of hearing from Tom Siomades. He is the Chief Investment Officer of AE Wealth Management. Go check him out on the internet. Lots of really cool tips and pieces of advice, and a lot of experience doing what he does. So, without further ado, we'll wrap it up, and I want to thank everyone again, and we will see you next time. Thanks, Tom.
Thank you, Brian.
This podcast is intended for the general public and for informational purposes only. The show does not provide any recommendations or investment advice regarding any specific account type, service, strategy, or product, or to otherwise act in any fiduciary or other capacity. Please contact a financial professional for guidance and information that is specific to your situation. Brian Caderna does not provide tax or legal advice. Please contact your accountant or legal advisor to discuss your situation. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Caderna Financial Team, and opinions stated are their own. All investments contain risk and may lose value. Past performance is not not a guarantee of future results. References to specific securities, asset classes, and financial markets are for illustrative purposes only and do not constitute a solicitation, offer, or recommendation to purchase or sell a security. Brian Caderna is a registered representative and financial advisor of Park Avenue Securities, LLC, PAS, OSJ 300 Broadacres Drive, Suite 175, Bloomfield, New Jersey 07003. Phone number 973-244-4420. Securities products and advisory services offered through PAS, member FINRA SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. PAS is a wholly owned subsidiary of Guardian. Caderna Financial Team is not an affiliate or subsidiary of PAS or Guardian. California Insurance License Number 0K04194.